All right, let's dive right in. Today, we're going to break down the fast paced, high stakes world of futures trading. It's a core engine of the global financial system, and you're about to find out exactly how it all works. So, let me just start with a question for you. How in the world can you trade on the price of crude oil or corn or even the S&P 500 without ever actually owning the physical thing? Well, the answer lies in a really powerful financial tool called a futures contract. So, first things first, let's get our heads around the basic concept. What is a future, really? Well, it all comes down to the power of a simple promise. At its very heart, a futures contract isn't the asset itself. It's a standardized agreement. You're basically locking in a price today to buy or sell something at a specific date down the road. The key thing to get here is that you're trading the contract, the promise, not the actual barrels of oil or bushels of corn. And this tool is incredibly versatile. I mean, we're not just talking about traditional stuff like commodities. Futures contracts cover pretty much everything, from stock indices to cryptocurrencies like Bitcoin. And this makes them essential for two main things. One is speculation, which is basically betting on where you think prices are going. The other is hedging. And hedging is really just a way to manage risk. For example, a farmer could use a futures contract to lock in a selling price for their corn months before it's even harvested. That way, they're protected from a sudden price drop. It's kind of like insurance. Okay, now for what makes futures trading so potent. We're about to get into the most powerful and, honestly, the most dangerous concept in this world, the double-edged sword that we call leverage. So what is the secret ingredient here? It's leverage. And how does it work? It allows traders to control a huge market position with a pretty small amount of their own money. Think of it like putting a 10% down payment on a house. You control the whole $100,000 asset with just 10,000 bucks. Understanding this is absolutely the key to understanding both the appeal and the danger of futures. And this is exactly why it's called a double-edged sword. On one side, leverage can totally amplify your potential profits. A tiny, favorable move in the market could mean a huge gain for you. But, and this is so crucial, it works both ways. That same power magnifies your losses just as dramatically. A small move against you can wipe out your entire investment, sometimes even more. So, we've covered the big idea and the big risk. But how does a trade actually work from day to day? Let's break down the mechanics of it all. It all starts with something called margin. See, to open a futures position, you don't pay the full value of the contract. Instead, you put down a small percentage as a good faith deposit. That margin is your collateral, and it's the key that unlocks all that leverage. So here's the daily cycle of a trade. First, you post your margin to open a position. Then, as the market moves, your account gets settled every single day with either profits or losses. But you need to pay very close attention to step 4, the margin call. If your losses drain your account below a certain level, your broker is going to demand more money, and they mean immediately. If you can't provide it, they will forcibly close your trade, locking in that loss. It's a critical and often very painful part of trading. Now, a really key feature of futures is that you can profit no matter which direction the market is heading. Going long is the classic approach. You buy a contract hoping the price rises. But you can also go short, selling a contract because you actually expect the price to fall. This flexibility is a huge reason why futures are so widely used. Okay, we've covered the what and the how, but now for what might be the most important part, the who. Who is this really for? Let's shift from the mechanics of trading to the mindset it absolutely requires. Think of this as the essential checklist for any would-be trader. Success here isn't about luck. It requires understanding volatility, accounting for every single cost like commissions and fees, and mastering risk control to protect your capital. But above all, it demands a clear strategy and the unwavering discipline to follow it, even when your emotions are screaming at you to do the opposite. This is not a hobby. It is a serious business. So in the end, the ultimate question isn't really whether you understand what margin or leverage is. We've explained the mechanics. The real takeaway is this. Beyond all the charts and the numbers, do you have the disciplined mindset needed to navigate this incredibly challenging world? That's the most important question you can ask yourself.